Chris Moll, welcome to Built to Sell Radio.
Thanks, John. Thanks for having me.
How did you get into the business of Molzi? Explain this company, how you got started.
Yeah, so Molzi was an Amazon agency set up about 6 years ago now. At the time,
what is an Amazon agency? I'm not familiar with that.
No, it's a good question. And I think if you ask my parents, they still probably wouldn't understand what it was. So effectively, what it turned out to be, although I didn't realize at the time, it was a digital marketing agency. So running pay-per-click, SEO, data analytics, copywriting, graphic design, but all fully on the Amazon platform. So it came about. I worked in sales for a consumer electronics brand. At the time, pretty much every brand was trying to avoid Amazon. You know, it was like, how do we control Amazon? How do we manage it? How do we not deal with them? Because they were seen as the enemy, because they were dropping the prices, etc. And most of our customers at the time were like music stores, things like that. And they were all going bust. Like every week another customer went. So we thought, well, maybe we should try and like grow Amazon instead of avoid it. You know, what would that look like? And it's this weird beast that even now with 1 million employees, there's not really anyone that speaks to you. You just have to, here's the tools, figure it out. And we did that, and we grew that electronics brand, you know, to significant revenue on Amazon. And that's where I came up for the idea of Molzi, to do the same, but for other brands. And I thought I'd invented the business model of an agency. I was like, well, I'll hire all these clever people, you know, sell them to other brands. And there was me thinking, you know, I'd created the most genius business model of all time. And it probably wasn't until 6 months in that I realized, oh, okay, people have been doing this for a while. And,
but it's unusual to focus exclusively on Amazon. Like we just did an interview last week with Mark Wright, who a UK-based digital agency owner, 130 employees, Climb Online. I've probably heard of it. But he was focused on horizontal platforms, so it wasn't just Amazon. He would do digital marketing for multiple channels. How did you decide to focus exclusively on Amazon?
So I think I viewed Amazon as a retailer, because, like I say, I had no experience of marketing or marketing agencies, so. It would never have dawned on me to, you know, do Facebook, Google, etc. So with Amazon, even though Amazon is a marketing platform, it's significantly smaller than Google and Facebook, or it certainly was at the time. As a retailer, there's not really anyone bigger. So I saw this opportunity for the world's largest retailer that no one really knew how to deal with, because it's all fully manual. Instead of shipping containers of stock to Walmart or Target, you're shipping like 5 units to Arkansas, 5 units to, you know, Massachusetts, whatever it is. It's like a real hard retailer to work with. But if you just learn how to use the tools, you've got so many levers at your disposal that you can pull, and small increments, because they're so big, can have, you know, the impact of millions of pounds worth of sales. So for me, it just seemed really odd that other agencies weren't focusing on it. But I think it's because the other agencies that we ended up competing with were charging like a percentage of ad spend. And the ad spend was just much smaller than it was on Google and Facebook. And they had to care about things that they didn't want to care about, like, was the product profitable? Was it in stock? Was Amazon, did they have the buy box? So I think it was just a headache, really. And so, and further down the journey, we would win clients from some of the big network agencies. And on the handover, they were like, oh, thank God for that. You know, we hated doing that. I'm so happy that you've won that business.
Interesting. And so what was your business model? If it wasn't a percentage of the media spend, how did you charge your customers?
So we charged a retainer just for, you know, turning the lights on. And then in most cases, we charged a percentage of the sales on Amazon. Because, well, first of all, the numbers were much bigger than the ad spend, so there's a much bigger opportunity to earn. But also, because most of the budgets on Amazon, well, there wasn't really budgets for Amazon. It tended to be a salesperson that had a spreadsheet, a P&L for Amazon that said, this is the sell price to Amazon, this is the cost for fulfillment, this is the cost for marketing, this is the cost for warranty, and then this is the cost for Molzi. So if they didn't sell anything, we didn't cost anything effectively. So they were able just to kind of add us as a line on a spreadsheet rather than us have to go and find budget, which was good at the start because we could kind of pitch the fact that we were free. You only pay for us if your sales grow.
But you're taking all the risk. How did you vet customers?
We didn't at the time. We literally signed anyone we could. We were very new business focused, I would say. The first two people, me and a colleague of mine, were salespeople basically. So we focused on let's sign clients and then hire some people that know how to do Amazon. And that, I think that naivety, paid off in a sense because since then I've seen a lot of agencies that will scale to a certain size, and then because they don't have a new business function, either like the inbound leads will stop or the network of the founder will have been rinsed. But we were, up until we were maybe 15 people, probably half the company was salespeople and the other half was actually delivering the business. So to answer your question, we kind of at the start, we just signed everyone we could and then quickly learned, that was a bad idea. These guys are good. Let's double down.
But you weren't just selling vaporware in the sense that you, through the consumer electronics brand, had sort of cracked the code on how to use Amazon. Like you knew.
Yeah, we knew how to win on Amazon strategically, and that was the bit that was difficult to find in the market. And then all of the bits that we didn't know how to do were a bit more generalized, like how to run the pay-per-click campaigns on Amazon. And the platform was so much more basic than Google. So we were able to hire people that had experience on Google and just teach them the strategies for Amazon. So yeah, we were selling the strategy and then quickly hiring the people that would do the work. But like I mentioned at the start, for the first year or two of Molzi, a lot of brands didn't want to deal with Amazon. So we were kind of selling Amazon. But that was, we were going into a pitch and almost not mentioning Molzi. We were pitching, why should you work with Amazon? And if they agreed, yes, we should work with Amazon, it was kind of like the assumptive close. Well, obviously we'll do it for you because you don't have a team. So yeah, it was a great time looking back on it. When you look back after the earnout and everything, I think that those were the best memories where we were just going to huge brands and almost telling them off for not doing a good enough job on Amazon.
But those huge brands typically have agencies of record where, if you're a giant, if you're a Canon or I'm trying to think of other giant brands that sell through Patagonia. I don't know if they sell through Amazon, but giant, consumer brands have agencies of record, and those agencies hold their clients very tightly. And in fact, contractually say, look, if you're going to do marketing, then we need to be the vendor of choice. How did you get around the AOR relationship these brands have with their agencies?
Yeah, so we had two strategies that changed over time. The first strategy at the start of our journey, well, it wasn't really a strategy, it was just good fortune, really, in that because Amazon was a retailer in most companies' eyes, it was being handled by a sales team who had no idea that there was an agency of record over here.
Perfect.
And so we were just doing it. They had no idea. They had the ability to sign off trade budgets for retail. And then at the point where it started, especially once we joined Brainlabs and became like a proper company, that we did start butting heads with a lot of these agreements. But we learned that as long as you could offer something that wasn't a capability of that agency, they could normally find a way around it. So what we did, we created what we called hook products, which was like really, really, really niche parts of what we could do on Amazon. So every time we'd create a product, we'd say, right, just imagine every client is working with MediaCom. Let's create 2 or 3 offerings that they would still buy from MediaCom, or even they would still buy from an Amazon agency. So one of those was Amazon, if a brand ships product to Amazon in like the wrong bubble wrap or a slightly different box to the one they promised or the wrong barcode, they just automatically deduct certain fines and fees off the invoices. So they're called chargebacks. And it became apparent to us that a lot of brands have got millions and millions of pounds worth of chargebacks that it might represent 2% of their Amazon business. And most cases, they just write it off as like a cost of doing business with Amazon. So we saw that as an opportunity because where there's cost, there's opportunity. I think Bezos said it best, your margin is my opportunity. So we hired a couple of people from Amazon that were basically the other side of that process. They were the ones at Amazon that were dealing with these claims and issues. And we created an offering that said, we'll help you create a business case to reclaim this money. And anything we win, there's no fee. Anything we win, we get 20%. So it's like the kind of no win, no fee. And we just never got a no. Like any brand that we pitched it to, yes. And it didn't work. It didn't work as well as we thought as a cross-sell because normally we were dealing with like a CFO or a supply chain contact. So it was a great way of signing those blue chip clients, but it didn't prove to be a great way of then cross-selling into media. But the only areas where it did work, the process of reclaiming these chargebacks required us to have access to their Amazon account. So as soon as we got access to their account, we were able to run audits on their media and then say, look, you're working with agency X. Do you realize they're wasting 24% of spend? And so that was our strategy, really. Try and, rather than waiting 3 years to pitch for some business, let's try and figure out what we can sell them tomorrow. And then we'll worry about how we cross-sell that into some more business.
I love the fact that you recruited right out of Amazon these two people that focus on chargebacks. And it's exactly the opposite of type of person I would have thought you would have recruited. When I think of agency, good or bad, I think of Mad Men. And I think of the kind of classic agency employee who's very creative, loves to pitch, and would reel at the idea of an Amazon agency working for some, agency that focuses exclusively on the kind of most commoditized part of e-commerce, this sort of like all about logistics, boring part of e-commerce. They want to be working on like sexy TV ads and cool digital campaigns that are going to run on, like mass networks. The idea of like going to work for some Amazon agency must have been a tough sell. How did you get people to come work for you?
I guess everyone's heard of Amazon. So again, we were kind of selling. When we were hiring the early employees, we were selling the Amazon dream rather than the come work for a badly funded startup. It's going to be great. And I guess because the platform was quite basic, because we had the overall strategic knowledge of Amazon and how the bits go together, we were able to hire relatively junior people to do the work. So it was kind of, this is the very early stages. It was like, we really want you to come work here because we need people. And they're like, well, I really need a job because I've not got a job. And it actually benefited us as we scaled up because as COVID came, obviously Amazon was one of the companies that really benefited. There was two things that helped us scale and really ride the wave at that stage. The first was the fact that we'd managed to create our operating processes with relatively inexperienced generic skill sets. So we weren't hiring Amazon experts who were very expensive in the market because there was a real shortage. So where some of our competitors were having to spend £70,000-80,000 per person, we were able to, significantly reduce that with the people we brought in. But also, for some reason, and I can't really remember the strategy other than it seemed exciting at the time. We opened an office in Hong Kong. We opened an office in Spain, just because we were like, well, we've got this opportunity as an Amazon agency before there's thousands of them. Let's take over the world. So we set up entities in Hong Kong and Spain. And then as soon as COVID hit and we needed to scale, it was like, well, we've got 3 places we can hire now. And actually, it turned out the the local talent in Spain, and then we ended up opening an office in Brazil as well. There was much less local competition for those guys because Amazon was much smaller in those countries. So we ended up, our team was getting poached every day on LinkedIn in the UK, but in Spain and Brazil, they were there was a bit of a moat around them, which is great because I think in COVID we scaled, it was something like 15 people to 50 people in about 4 months in lockdown. So we were just hiring and signing clients over that period of time.
That's incredible because, of course, the explosion of people needing to buy online, and obviously Amazon was the place that they went to do that. And so all these brands needed help. Amazing. You mentioned badly funded startup, which I think is fun. How did you finance this company? Was it all you in the beginning? Did you have investors or partners?
So I set the company up myself. We kind of remortgaged the house and I think we put £15,000 in, something like that, just to almost just like to pay myself some kind of salary. But the company actually started not as an Amazon agency. It started as a more of a generic sales agency that was helping brands get into retail. But it became apparent, two things became apparent quickly. One, everyone's problem was Amazon. And two, all those other retailers were dependent on human beings making decisions. Like, yes, we will range that product. No, we won't range it. Let's speak in 3 months. And it was clear that there'd be a lot of just waiting around if we were dealing with normal retailers, whereas Amazon was just a set of tools that if we could get really good at using it, there wasn't really anything standing in the way of the scale. So fortunately, I mean, an agency business is quite easy, really, in that you've got clients paying you money and then people doing the work that kind of scales in parallel. So we were always able to sign a client and then hire someone retrospectively to service it. So we probably never used that 15,000. It just kind of it was there as a safety buffer.
And did you keep 100% of the equity the whole way through, or did you have a?
So I took investment about year 2, where I think about 15% of the equity in return for investment in the business. The reality was we didn't really need the money, but obviously we got some money and were kind of pressured to use it by the investors. At that stage, we were kind of coming up against these like wave makers, Mediacom. We were coming up against these big companies, and like I said, we had no idea what was good about them, what was bad about them. So we brought, I think it was three or four people on at that point that had either built and sold a digital agency, because I knew that was my end goal, or they worked in senior positions within those big agencies that we were trying to compete with. So it was really to try and get some knowledge in place. But also, as much as I didn't enjoy it later on, I kind of asked them to, hold me accountable. Like, we've got an opportunity here where we're on a wave and we're quite near the front of it, but you need to put me under some pressure to hit some numbers. Otherwise, it's easy just to be like, oh, we didn't hit the number this month, but there's always next month. And I used to hate those meetings, but looking back, there's no way that we would have grown the way we did without them.
Interesting. So you gave up 15% of your equity in return for some investment. How did you value the company at that early stage? Like, what methodology did you multiple revenue?
Yeah, I think it was valued at like 2 times revenue. The reality was it was so small at that stage that it was just kind of like a finger in the air. And I going into it, I always kind of thought in my head, a lot of people start a business with someone else, so they start with 50%. So I always thought I'll use 50% to try and make the other 50% as valuable as possible. I think by the time we sold, I had 75%, so we didn't need to give away too much. But actually, 1 year before the acquisition, I sold 10% of my shares to take money off the table, just as like if we're going to really go for this, I need to de-risk and not have all my eggs in one basket. And it worked quite well. Obviously, once you've done the acquisition, you kind of work out what it would have been worth. But I think the ability to let me think, well, at the very worst, it's been a success. Now let's just try and drive it as hard as we can.
I'd love to dig in further there. So where were you at when you decided to take 10% off the table? In other words, sell 10%? Because in the first sale, you raised 15%, but it wasn't to put money in your jeans. It was to fund this growth of the company, its next level with these competitors coming on. It sounds like in the second raise, where you sold 10%, it was motivated to quote, de-risk yourself personally. And so walk me through that. I think when people think of a minority recapitalization where there is an investment being made in the company, it's to grow the company, not to enrich the founder. So walk me through how that all worked.
Yeah, well, so the idea first came, I still remember now, sitting down in March 2020, listening to Boris Johnson tell us all that we were going to be locked in our house, and just saying to my wife, "Is that it gone? Like all of that work, and it's probably going to go bust." And even though that feeling didn't last long, because suddenly we were like, "Oh wow, Amazon's still going, it's growing." There was just something about I knew that I wanted some kind of de-risk. But at the time, I would have had to sell a lot of equity to. But basically, what we said was, let's pay off the mortgage, and then it's like we've come out of it at the very least with a win. So obviously, I knew how much I needed to pay off the mortgage, and then just work backwards from there. And said, well, I don't really want to give away more than 10%, so we've got to grow the company to this value in order for that 10% to be worth that. And I actually used the same strategy, I guess, for working out what to sell a company for. Because before Brainlabs, we had 12 other companies approach us over the period of probably 7 or 8 months. But I'd kind of figured out, well, this is what I want to do with the money. We want to buy a new house, like our forever home. We want to be able to not live like a luxury lifestyle without working, but worst case, know that we're set for life. And then figure out how much I'd have to pay the tax man, figure out how much equity I've got left. And then I pretty much knew if an offer comes in for that amount of money, I'm going to take it, because that's what I need for all the things we want to do.
So roughly how much money did you have left on the mortgage at the time?
I think it was like 300,000.
So you're thinking, okay, I need to pay off the mortgage. So 300,000, if I can get a $3 million valuation, £3 million valuation for this business, I can sell 10% of it, put £300 against the mortgage, and still own whatever, 75% of the business, right?
Yeah.
That was the calculus you were doing in your head. And so who did you get to buy 10% of the business? Like who did that transaction?
So it was actually a guy that had previously sold his digital agency, had done very well for himself, and now has a digital agency incubator and accelerator, effectively. I think normally they invest a bit nearer the start of a business for a kind of larger return, but I think the opportunity was there for probably a smaller return on the money than would be normal, but over a very quick period of time, because we were like, we're doing this now. Our aim is to sell it this time next year. Probably the valuation we did that the 10% at was below what it was, certainly in terms of multiples, etc. It was less than.
How much was your revenue at the time? Ballpark.
It was probably about 3 million, I think.
Yeah. So he got in at like one times revenue, so a discount against what you sold the first tranche to, but it was valuable to you because you wanted to put it into the mortgage and not into the business. So it was. I think I knew, just knowing how my head works, I knew that the security would allow me to be a bit more brave with the decisions, because naturally I think I'm quite risk averse in
So a lot of the big decisions we had to make where we were investing EBITDA back into the business, we had a spreadsheet that we called the Bible, which was just like everything about the business and what was happening and what might happen was on this one sheet. And the tab that I looked at was the cash flow forecast that would give me like about 7 worst case scenarios. This is the worst case. This is the worst case. This is the worst case. And I would just, whenever we made a decision, I'd stick it in the sheet and be like, even worst case, we're okay. So let's do it. So I had to kind of like train my brain how to take risks. Whereas doing this, it just allowed me to really go for it in that last year.
Yeah, it sounds like it, knowing that you've got that first rung of Maslow's hierarchy of needs taken care of. You're not going to fall off that rung. You've got security and a house, like a roof over your head, et cetera. And that gives you a sense of security. It's interesting because I think that's a major, factor in a lot of complete outright sales, or at least majority recapitalizations, when a private equity company comes in and they've just got very deep pockets. And so a risk to them is minor relative to you. It might be massive. And so it's a point where it may make sense for another owner to come in and own your business. So I appreciate you sharing that. You've mentioned a couple times, I've seen some of your blog posts. And by the way, everybody should check out founderon.com, your blog. It's great. And I'm excited to be a follower of yours there. In one of your posts, you talked about this idea of building to sell. Like your intent was to sell. And again, for a lot of people, particularly creative industries, agencies, and again, I know you are a unique agency and I shouldn't probably lump you in the same kind of group, but the idea of building to sell is a bit squeamish for people. Like they kind of revolt at that idea. They think, oh, that's dirty. That's the underbelly of entrepreneurship. It's such a money grubbing thing to do. In your case, it sounds like it was your intent from the start. Maybe walk through that.
Yeah, it does sound bad. But it was the goal. My passion wasn't Amazon or marketing. It was Molzi was an opportunity that I saw to kind of see a gap in the market, etc. But actually, since doing it, and obviously since leaving Brainlabs, you kind of start thinking back to the good old days, and I think as a result, any business that I do now would be a business designed for me to run and enjoy and invest in, because there's something about growing a business to sell that is quite uncomfortable. You can't really, where you're looking at like, well, we could invest in wellness programs or we could hire another salesperson, but you've got to make decisions which are for the exit really, rather than to make the experience enjoyable for you as the founder. I don't think I enjoyed a lot of the journey as we start to scale because we did it in a relatively short time frame, 4 years, and every time we hit like a different milestone of numbers of people, like maybe every 15 or 20 people, just everything had to change. Like all the processes were wrong. Suddenly it's like we've got to build more desks, we've got more office space. And I didn't really enjoy those parts of it. I enjoyed working with the team, working with clients, signing new business. And that's the reason why eventually I decided to sell, other than obviously the right offer coming in. We had about 80 people at the end, and it just wasn't my skill set really. My skill set was 10 people around a table with a whiteboard. How do we fix this tomorrow? Or how do we fix this now? Rather than how do we get people along on the journey with this strategy? How do we communicate it to all the different offices? It lacked some kind of pace. That was the bit that excited me. So I think now that I've kind of had the exit with Molzi, my aspiration isn't just to keep building businesses to exit. I think now it's like, how can I build a business that I really love working at? I can really enjoy working with the team and not thinking just constantly, right, let's push this until it breaks and then move on to the next stage.
Isn't that interesting? So building to sell, creating, having the liquidity of that, having the wealth that you've created has caused you to now aspire to almost like a lifestyle business. One, I don't want to say that in a pejorative way, but one in which you're thinking more about culture and making investments that are perhaps less easily tied to valuation.
I think so, yeah.
Give me an example. You mentioned hiring that salesperson versus that wellness program. What sorts of decisions did you make? And how did you prioritize building to sell versus creating a lifestyle business? Like the wellness thing versus, investing in a website. I think that's a nice one. What other sorts of decisions did you make differently because you were building to sell versus creating a kind of a lifestyle business?
So I think, I don't know if it's going to properly answer the question or not. Tell me if it doesn't.
Sure.
But I guess one of the things around culture that I noticed was so culture just naturally happens, I guess, at the start, because no one's got time to write down, right, what's our culture? And let's make sure we stick to it. So our culture naturally was tenacity, pace, ambition, because we were trying to build this thing big enough to not go bust initially, and then big enough to ride this wave and try and kind of exit at the top of it. And as a result of that, the people you bring in are kind of fully invested in that, because you're literally all sat around in an office and living and breathing it. As we started to get bigger, and we were hiring people maybe that had worked at proper companies before, and that's when we started getting problems with, like, people were getting stressed, or people had issues with, like, we need to not grow as fast. We need to not sign clients because things aren't working anymore. And we were like, well, of course they're not working. We need to change them, and we need to. And we spent probably 6 months creating wellness programs, or like, should we give people more holiday, or like give them their birthday off? Should we send them gifts? Like, we were like very non-HR people trying to create HR solutions. And then it kind of dawned on us, maybe we just need to be a bit more honest in the interview. So instead of like, come work for us, you're going to get a free gift and extra days holiday, but hide the fact that, and it's going to be, a bit crazy and things are going to change. Our interviews started to become like, it's tough here. It's going to be a hard place to work. You might not enjoy some days, but you'll probably accelerate your career a bit faster than you would if you were, in a more corporate environment. And it just fixed the problem really quickly. We kind of got people that thrived on that challenge. But obviously, eventually, we did implement proper HR strategies and those things. But there was that short period, like a kind of gangly teenage phase, where we were just like trying to put plasters over things, that we were like, maybe we just need to be a bit more honest with people on the way in, that it's going to be constant and change and difficulty. So that kind of fixed some of the problems.
I love that. I that's a great response. It reminds me of a buddy of mine does a 3-step interview process. First steps in the process would be, as you imagine, a screening interview, then an in-depth interview, and then this third interview. The objective is to try to convince the candidate not to take the job. Yeah, like his whole stated purpose is to try to talk to the candidate out of the job, describe all the bad things and the bad parts of the culture and all that, so forth. And it's for the reasons you stated. It's because he wants to be super transparent about the culture and doesn't want to change it. And I love it. I think that's great. I think we're, have been socialized in the world of entrepreneurship to think everybody's got to have be their full fulfillment at work, and they've got to have a best friend, and not every environment is that. And so being transparent about that, I think that works as long as you're transparent, right?
And I think actually you end up building good relationships because you there's something about just being constantly slightly off comfortable that brings a team together.
Yeah. I think it was Bill Gates who said like he'd figure out like how like a project would take or how many people he would need, and he'd have like 70% of that staff on it, or that head count. So like everybody was just slightly stressed all the time. So I love it. So let's get into the sale, because you mentioned in the months leading up to Molzi, you had a number of inbound inquiries. Like maybe walk through that. Were you seeking them out or soliciting them? Or were they completely unsolicited? Just describe that process.
So I guess technically unsolicited. One of the things we did, again, in the same way we didn't know what a digital agency was, we also didn't know what content marketing was, but we were kind of doing it by accident. So from quite early on with Molzi, we would share either like controversial views on retail, the future of retail, or like, here we are at Amazon's office learning about things. And so we made the kind of journey of Molzi quite visible. And I guess because I always knew one day I wanted to sell the business, I would always like try and connect on LinkedIn with people that I thought maybe one day might want to buy the business. In my head, with the hope, I'd connect to them, they'd look at my profile and go, let's buy the company. It wasn't quite that quick, but probably over 2 or 3 years, all of the people that ended up contacting us had been following us for a long period of time and not engaging with us in any way, not liking any of the posts, not commenting, not messaging, but I guess just there, getting it whether they want it or not, getting the post. So I think it probably got to the stage where someone just got told, you need an Amazon capability. It's like, oh. I think probably the view was that we were a lot bigger than we were, just because we would encourage a lot of the team to post on LinkedIn if they wanted to, even though we knew that it meant they were going to get poached more often. But it kind of gave that impression just of size, because it wasn't just me and a couple of other people posting all the time. So all of the approaches that we had were kind of people that I'd heard about or knew about, but a lot of the offers were like an amount of money and then some kind of share swap or something linked to the parent company. And obviously, as soon as you start getting offers, they all look good in the sense that you just start imagining, well, that'd be good because that's a lot more money than I've got now. But then it wasn't the amount of money that I decided that I needed in order to kind of fulfill, because probably Molzi will be my one opportunity. Maybe something else will happen, but I had to kind of assume this is my go at it. So if I don't get that, then I'm probably never going to get that. What was
that for you?
Say again?
What was that for you? If we're not going to get that, I may never get it again. Like how much
amount of money? Then I'll probably not get the the house that we're looking for or all that kind of stuff. So
yeah,
because we knew what we needed and that this probably would be our only shot at getting it, that kind of led a lot of those discussions. And obviously we never just said no, never speak to us again. The great thing about M&A approaches is you can always say no and then grow a bit and then speak to people later on. So we always tried to be very nice to people. That was always our business strategy: work hard and be nice to people.
But they would come to you directly, as I understand it, not through an advisor that you hired. They would just come to you directly, connect with you, and engage you in some sort of conversation. That must have taken you must have had a few conversations to get to the point where they put a value on the table. Is that right?
Not always. Sometimes they would say in the meeting, like, this is roughly what we're thinking, or they would give information about how they were going to structure a deal.
And what would they tell you? Like, how much detail would they give you in those meetings?
There was never like LOI style, here's the terms, but it might be like roughly this amount of money plus 5% shares in this, or some kind of percentage of earn out linked to growth, or whatever it was. But often it would be a company that had already acquired an Amazon agency, for example. So that it like limited our prospects in and out, because we would be very much just like the UK bit. Or in some cases, you could tell they were just buying us for the clients, and then they would get rid of us, which wasn't a great opportunity for the team. But with Brainlabs, it was, I guess, the financials were good, but also there was a culture fit. They were also very fast growth, very ambitious, founder led, and it just kind of, I wasn't expecting all the boxes to get ticked, and with Brainlabs, it did. And after 12 goes, you're so used to just being like, here we go again. No. And it was just, I kind of left the call and I was like, I think it's yes.
Interesting. I want to get into Brainlabs because people may, longtime listeners of the show will know 𝙁𝙊𝙐𝙇𝙊𝙁 sold his agency to Brainlabs. So we'll that name may be familiar to people. I want to get to Brainlabs in a minute, but I want to just dig in a little further on the actual kind of failed attempts to buy your business, if you will, the dozen or so folks that sort of approached you. Ballpark, you're 80 people at this time. Ballpark revenue, what would your turnover be? Ballpark at this stage of the game?
It was probably like 4.5 million, something like that.
4.5 million pounds.
Yeah,
turnover. And are you starting to get any sense of what the market and profitable, like ballpark?
So our strategy was always top line growth at any cost, and it was. I mean, I wouldn't change it because of the outcome we ended up getting, but I think would I do it again? It would have been relatively easy to run our business very profitably, but we were so focused on revenue growth that we just reinvested as much EBITDA as we could and probably wasted a lot of money just on like because Amazon was this shiny new thing. Pretty much all the approaches we got, there was never a mention of EBITDA. It just wasn't a factor. It was people wanting to grow the one that's grown. People wanting to buy the one that's grown the fastest, because a lot of these marketing groups, when they're kind of pitching to their private equity investors, or if they're looking to roll up for their own trade sale, they've got Google, they've got Facebook, and they need this third one that's a bit awkward. So actually, probably in a lot of cases, the businesses that were pitching to buy us probably didn't even care what our numbers were. They just wanted like the impact on the multiple when they sell their business, because it makes them a bit sexier or a bit more unique.
So they were thinking about it in the context of their multiple, that if they could tick every box, we got Facebook, we got Amazon.
Well, that's my assumption. I don't know if that is the truth, but there was a short period of time where everyone wanted an Amazon agency, and there weren't many that had scaled like beyond lifestyle business. So it almost didn't really matter about the numbers at that stage. Certainly not EBITDA.
Did you get a sense, Chris, that musical chairs, we all played it as kids, that the music was about to stop for Amazon agencies? In other words, once the big buyers had bought themselves each an Amazon agency, the market for Amazon agencies would crash. Did you get a sense that the music was about to stop?
I definitely worried about it. And we always spoke internally about, we're on this wave, let's make sure that we get out before it drops. And obviously COVID was a huge accelerator of Amazon's own growth. And looking back now, retrospectively, I think we would have had a tough year the following year after we were acquired, because obviously the kind of COVID e-commerce growth normalized a bit. Plus like interest rates, cost of living crisis, Ukraine. The world became a very different place quickly. Yeah. So yeah. I think we probably exited at a good time. And as a result, we became part of a much bigger machine at a time when it became a bit harder. And actually, at a time where a lot of those Amazon budgets had started to move to the CMO. Like a lot of those CMOs were like, what are you doing spending marketing money on Amazon? You're a salesperson. This is my territory. And we had no network of CMOs, and obviously Brainlabs and all these network agencies, that's their bread and butter. So I think we timed it well, more out of fear than strategy.
Yeah. So you're roughly £4.5 million in turnover. You're getting these offers. You'd sold the first tranche, although it was the back of a napkin valuation, and it's very early at around 2 times revenue. The second tranche at 1 times ballpark. Where were these offers coming in ballpark at in terms of multiple of revenue?
It was almost impossible to tell because they were all structured so differently. Some were even just like, here's an enormous salary, and you'll still retain this amount of shares. Some were, here's a couple of £1 million, so that so you can buy the nice house, but you've really got to work for the next bit. Some of the earnouts were 5 years, and there was no trend. It would have been easier if we just sent out a template and said, please fill out this so we can compare them. But actually, it really came down to things like, I'm going to work here for the next 2 or 3 years. Do I want to work here? And with Brainlabs, I was like, this is a place that's going to be cool to work because they're all about the growth and disrupting the market.
So all of them had some sort of back-end payment, again, either an earnout, a share swap, a salary, where a lot of the value was, quote, at risk in your role as a division of their company.
Yeah. So I was either putting my faith in myself or ourselves, or actually in them. A lot of it was shares in the parent group with no real control over, how that performed.
Could you ballpark the downstroke, meaning the cash component? Like when they pitched it to you, they're like, hey, Chris, come work for us. We'll give you a couple £1 million up front. And if you hit it out of the park as a division of our company, you could get this in the form of an earnout. I'm trying to get a sense of the proportion of these deals. And again, I know there's a variety of them. They're all over the map, that were sort of downstroke cash up front versus the future payment. Were they 20% down and 80% in the future, 30% down, 70%? Can you give me any sense of the proportion?
Yeah, so they were probably all 25% down, 75% opportunity, but not in the sense, but not based on the true value of the business. So because we'd just gone through COVID and because our numbers were doing this, they were kind of open-ended earnouts. So if the business continues to grow at this pace, look what you could make. But the reality was, it's not going to grow at that pace. So if the upfront cash as a percentage of what probably was the value of the business, it was maybe 75%. But in the way that the deals were visualized, with kind of everything going our way with the wind behind us, then it was a small proportion, if that makes sense.
Yeah, no, for sure. But you knew that the likelihood of continuing at that breakneck speed was low.
So I did, but still had faith that it was possible, particularly joining a bigger business and going after some of those bigger budgets. We'd also started to introduce some other service offerings, which in hindsight were maybe complicating what we did. We'd probably strayed away from the fact that an agency business is quite simple. We should have stuck to that. But we were like, because suddenly with the earnout, you go from, here's a business where if we grow it next year, that'd be great. But if actually it's in 3 years' time, that's fine as well. And then suddenly an earnout is, right, I've got a set amount of time where I've got to hit specific targets. So we were like, right, here's the number we got to hit. Let's just start creating all sorts of offerings where we can hook into clients. So we probably overcomplicated it a bit to our detriment. But one of the investors gave me advice as we were kind of entertaining all these offers, which is you've got to be happy with day one money. Like whatever earnout is promised, whatever mechanics, but the back end, you've got to be happy if it's just day one, because you don't know, Amazon could go bust the day after or whatever it is. And obviously, I definitely went for the earnout, but I was still happy the day that I signed the bit of paper with kind of the initial deal. And I would pass that advice on, I think, to anyone. You just don't know, no matter what's going on in your business, what kind of growth trends you've got. You just don't know what lies past that SPA. So just make sure that one way or another you're happy with day one's money.
How much did platform risk play into the structure of the deals you were being offered? We talk a lot about something called Switzerland structure, where you're trying to lessen your dependency on any supplier, customer, employee, stakeholder. In this case, you were all in Amazon, which was great in the sense that as Amazon grew, it's like the rising tide lifts all boats. And at the same time, you were all in Amazon. There was no diversity. You were an Amazon digital agency. And I would imagine some of the potential acquirers would have viewed that as platform risk. Did that conversation come up at all?
It was only seen as a benefit at the time. I think because I think if we'd done other things, it would have been seen as a negative because people specifically wanted that capability. I think probably the risk with Amazon would be some kind of regulation. That's probably the great, like the ads business being split from retail. A bit like if you're a TikTok agency, there's probably the risk that TikTok is just banned from the countries you're operating in. But the reality was, Amazon was this kind of third major marketing platform that was still in its infancy and growing fast. That they just needed that capability, and they knew it was so different because of the fact that Amazon's retailer first and a media platform second. Although Amazon will beg to differ now, they knew they just needed to buy that capability because it was so hard to create. So it was purely an advantage. There was never mentioned. The only time it was ever questioned, actually, I can't remember why, but we went to see a venture capitalist in London who'd expressed an interest in investing a bit before I took some money off the table. And I'd never had any dealings with venture capital. The first slide on the deck was just like a summary of Amazon. And we spent like 40 minutes where he was like grilling me on Amazon's business model, saying, I just don't think it's going to work. And I was like, well, it's definitely going to work. They're one of the biggest companies in the world. Don't worry about Amazon. They're fine. Can we get onto our slides? Like, I just don't think Amazon's sustainable. It's just not going to work. So it is this kind of beast that just everyone buys from it, but no one really understands.
Well said. So let's get into Brainlabs. How did you come to know the Brainlabs folks? How did this sort of tell me the first step that they made or you made to them?
So actually it was one of their I think he was a non-exec director, used to work a long time ago in an agency with one of our investors. He kind of just shared to him, we're in the market for an Amazon capability. They had recently taken private equity investments, so they were part of a roll-up. And because one of the things I loved so much about Brainlabs was their ambition, they'd kind of taken the private equity investment, and I think they'd already bought 5 companies before us, whereas a couple of the other roll-up agencies had taken investment and then maybe kind of 12 or 18 months in hadn't bought anyone yet. And that kind of, to me, screamed like indecisiveness, but maybe they were just being really careful. So that appealed to me.
So Brainlabs had gotten a check from a private equity group to go acquire companies.
Yeah, that was very much their strategy. They were a Google SEO business, and they wanted to gain those capabilities, and very much scaling up for world domination, which suited us. And Dan, the founder, I think Brainlabs now is like 10 years old, so you could almost on a graph plot Brainlabs' journey in terms of numbers of people and revenue and just overlay Molzi. So just lots of things seem to make sense. The fact that he wanted to meet up walking around a park in London rather than in an office with a PowerPoint definitely suited my kind of my style of meeting as well. And yeah, it just felt good. We just chatted about. He explained, when he did his kind of part exit to private equity, how it felt, and it was very much just like it felt like he was giving me advice as well as, I guess, pitching. Whereas a lot of the big agencies that had just been, look how big we are. Of course you want to join here. We work with L'Oreal or Bacardi, whatever it is. It was actually on the walk. I think we just agreed, should we do this? I was like, yeah. And then I was like, how does it work? I've never done this before. And that was when we kind of hired an M&A agency who were amazing. But I think slightly unusually, we kind of went to them with, here's the company that's going to buy us. If you could take it from here. And the experience with those guys was amazing. A company called SI Partners based in London. And it genuinely, me and Dan, the founder, we used to meet up for a walk every 2 weeks, just discuss life, discuss how the business is going, but never worry about the negotiations or we've spotted this issue or there's a bit of a challenge over these, whatever it was. We got to just kind of maintain the high five, cartwheel culture. And then the M&A advisors got to do all the hard work of, making the numbers work and make sure due diligence went smoothly.
That's really interesting. I just did an interview about 3 weeks ago with a guy named Tyler Smith, who he had exactly the same strategy in the sense that he hired an M&A firm. They instructed him not to talk price with the buyer. The buyer of his company was this giant billionaire who made efforts to ingratiate himself with Tyler and connect and personally, spend time together. And it sounds like Dan did the same thing, but never did they sort of get into the weeds of the negotiation directly. They always let the M&A professionals do their work, which sounds like you did as well.
I think what I really liked was Dan himself had created this business, had kind of a partial exit with the private equity. So I was able to just, ask him, like, how did it feel when it happened? And what have you done since? How's your life changed? And without wanting to plug the blog, the idea of the blog, is really like the blog that I wanted to read when I was going through it. The idea is that it's like not how does the M&A process work or what happened on the day that I signed the deal. It was like, how did I feel when I was doing it? Because I was just like a sponge, desperate for that information, because I wanted to like prepare myself mentally for, is this going to be amazing or is it going to be really normal, or is due diligence going to take over my life? Is it going to be horrific? So I think, again, that's one of the reasons why Brainlabs seemed like a great fit, because it was an individual who was kind of in the same position, who was able to share some of that experience, whereas the people you're dealing with at a big network agency are, they've got a budget that's their job to allocate, rather than them individually that are feeling the feelings, if that makes sense.
Yeah, it does. How did the specter of valuation come up?
So they just made an offer. It was actually, weirdly, I just had a hernia operation, and I just got out of hospital, and I was on like every drug you can imagine that was offered to me. And Dan wanted to have a call because I think it was quite time sensitive. I can't remember why from their side. And I was like, I'm just warning you, I'm not fully with it. And we had this call anyway, and then he gave some details of the deal just verbally. I wrote them down, and then I looked at them the next morning. I'm like, I've literally no idea if that's real or not. Like, I can't remember the conversation. So I had to message him and go, would you just be able to pop that on email? Just that I've put enough zeros and decimal points here and there and everywhere. But yeah, they just made an offer that was really straightforward. No shares, no equity, just here's an amount of money and here's some more if you hit some numbers. And that simplicity just suited my brain, because I'm not an M&A expert. I don't really understand how these things work. But the salesman in me knew we've got some numbers to go after now, and this is what we'll get if we do it.
Got it. Are you able to share any detail about sort of what the cash component was versus what the earnout was? Anything that you're able to share would be helpful.
So kind of the total that we ended up with was like very low, very, very low 8 figures in dollars, or very high 7 figures in pounds. Probably the upfront element of that was 75%.
And the earnout, was that tied to top line revenue or profitability or client retention? How did they structure the earnout piece?
Yeah, it was purely based on revenue. The opportunity was there to make a lot more than that. It was almost open-ended. But like I say, the market changed a lot. Also, I don't know. I was running the business of Molzi. I was never client-facing. I didn't know how to do any of the work on Amazon, and kind of weirdly, very quickly became redundant. As in, I didn't really know what to do anymore. I didn't know how to pull the levers in the same way because I maybe didn't have access to the same information that I had. So the first year of earnout, we managed to hit, and it was like the old school hard way of just like every deal out. Can we get that invoiced? Can we get another $5,000? Can we? It was just like, it was the hardest bit of Molzi was that first year's earnout by far, because I knew that we either did it or didn't do it. There was no like, oh, well, there's next year. And that was by far the most stressful part of the journey for me. And which is fine. But in my head, I thought that would be the easy bit. And that would be the kind of lying on the beach, living the dream. And then suddenly it's like, oh my God, it's so much harder, this. And suddenly, because I'd obviously got the money for selling the company, suddenly I was like, well, loads of people are relying on me now. Some of the employee shareholders, the investors, so I was kind of suddenly doing it for them. It was just really, it was really stressful. And I think when we hit that first year, it was not subconsciously. I think my body just shut down and went, "We're done. This is someone else's fight now." Because I guess I'd achieved the income from the deal that I was aiming for. In fact, it was more because we managed to hit some of the earnout, and it was just. I just was a terrible employee, not like a bad behaved employee, but I realized that in order to operate, I need to see like a bigger picture, because I like to try and solve problems or whatever. And if I don't know the reason why things are being asked, then I can't do that. So yeah, I just got in the way. I think I saw one of the other podcasts with, where someone said similar, you kind of go from being everyone coming to you going, Chris, can we do this? Can we do this? To being like, oh, I thought you'd already left. It's like, oh, okay, probably should show my face a bit more often. But it is weird knowing that you're kind of just getting in the way. And so before leaving, I had to have quite a few of those conversations where I was like, I just don't know if I'm helping you or getting in the way. Like, I think I'm just blocking someone from doing a better job. And that's when ultimately I ended up leaving.
Talk to me about the earnout structure. So it sounds like it was in tranches, annual like payments. Was it in perpetuity, or is it like a structured like 3-year earnout where each like a payout for each year was available?
Yeah, so it's 3 years with like a cliff and a max. So as long as we got above the cliff, then we got something. If we got below the cliff, then we basically lost that for that year. So yeah, that was exciting and motivating, but yeah, very, very stressful. knowing that it's like happening or not happening, and it's still huge amounts of money that are life-changing amounts of money that could maybe just not happen.
So the structure, you had to hit a top line revenue target. If you did, and that exceeded the cliff, the minimum, then there was a payment. That payment, was it a percentage of revenue? Was it like how do they calculate what that payment would be?
So it's basically between cliff and max, there was just like a linear calculation from that amount of money to that amount of money, and wherever you are on the journey. So again, once we'd got over the cliff in the first year, it was like literally everything we bring in now is money. You know, it's incredibly motivating. But I guess where it doesn't motivate is if you're not going to hit the cliff. You can't sandbag revenue because the numbers just keep getting higher and higher.
Right. So year 2 numbers are higher than year 1 numbers.
Yeah, it just keeps scaling and scaling and scaling. So effectively, if you miss 1 year,
you're done.
You're done, basically.
Yeah.
But it was the structure was very simple. It was revenue. It was made clear what counted as revenue, and because we were the only Amazon capability within Brainlabs, there was no fighting over, is that your Amazon revenue or my Amazon revenue? So the deal was structured great. I think I just didn't know how to drive it in the same way once I was in a larger business. Mm-hmm. And I don't know if that was genuinely I didn't know how to do it, or if the motivation had gone because I'd got the kind of day one. It wasn't intentionally. There was certainly no intention to go, well, I'm fine now, so it doesn't matter. But I guess you don't know what's going on subconsciously in your mind. But I definitely really struggled to operate in the same way, because Molzi, everything we did was about kind of pace, and we'll worry about the risk if it comes, and then deal with that. Whereas once you're in a bigger business that's got a bit more regulation, you can't be as gung ho, and that's probably where my skill set.
So you left shortly after the end of year 1.
Yeah, I think it was almost exactly a year and a half. Yeah,
okay.
It was all in good terms, because I wanted to make sure that they didn't see it as me abandoning them if I left. So, you know, we had lots of discussions about is everything integrated, and it became quite clear at the end that I'd integrated very well, meaning I had nothing to do.
You were redundant. What was Dan's reaction when you first told him you thought maybe you were going to call it?
I think probably because it was clear we probably wouldn't hit the numbers for the next opportunity. It was probably expected. I think as a founder himself, I think he understands, you know, there's just something in your blood, isn't there, that you just want to get going. And I mentioned in one of the blogs, another plug, when I kind of sold the business, signed the DocuSign, I was waiting for this kind of feeling of euphoria, and it didn't come. And then we thought, well, maybe once the money hits the bank, and we waited and stared at it, and it didn't come. So I'd lost faith that this feeling exists. But actually, 2 weeks ago, or whenever it was that I left Brainlabs, nothing negative towards Brainlabs, but just knowing that I could kind of just do whatever I wanted now. I think it was the freedom that I was looking for, not the money. I guess it's the impact that the money has, but just knowing that I'd kind of come out the other end of it, everyone's still friends, people consider it was a good deal, investors, employees, etc. And just like every muscle in me relaxed. And then quickly started stressing that, what am I going to do? I've got no emails. Like, no one even knows my phone number on this phone. But that was, that's a good problem to have.
It's an amazing story. Congratulations. Are you up for a quick lightning round before I let you go?
Oh, okay. Let's try it.
All right. What was the most questionable / slimy trick a potential acquirer tried to play on you in those dozen or so failed attempts to buy your business?
So the worst one was, it was one of the big network agencies. And I think it was like a global COO. It was one of the big guys was on the call to close the deal. And it was just the most horrendous, like skin crawling pitch about how they were so much better than we are already. They don't really need us, but I'd be an idiot not to take the deal. And you could just tell as we left the call, he was thinking, it's in the bag. And as soon as you hang up, it's like, Jesus, not for 500 million would I take that deal. But there was no underhand tricks from anyone. It was interesting to see the different pitching styles.
I went golfing with my kids the other day for the first time, I think ever. Maybe I once did it. And I had to describe what a mulligan is to my youngest. Mulligan being, of course, when you duff the first shot on the first tee, you get a second chance without deducting from your score. If you had a mulligan to sell your company all over again, what one thing might you do differently?
So I think the only thing I would do differently is I would, during the running of the company, I would have focused more on EBITDA and less about just chasing growth. For a couple of reasons. It would have given us more opportunities for an acquirer that valued EBITDA over growth. It would have opened up more options. But also, once we entered the earnout, we would have had more levers to pull. I guess when you don't have EBITDA, well, I guess if your earnout's based on EBITDA, you can grow the revenue and reduce the costs. Whereas if it's based on revenue, that's your only option. There's no point in reducing costs because it has no impact.
We just heard about the highest moment of your exit being the freedom you felt 2 weeks ago. What was the lowest emotional ebb you reached during the process of selling?
Oh, during selling. Well, probably after, the first year of the earnout, when I realized this is going to get harder rather than easier. But actually the process of selling, I kind of weirdly enjoyed. Even though it took over my life for 4 months, and it was just basically answering horrible questions and reviewing documents. It was almost like someone was just doing like an MOT on the business, because you kind of create this thing, and they were jokingly saying, "Oh, we'll see if we can find any skeletons," and I was kind of laughing, thinking, if you find any, I don't know they're there, but we've got an entity in Brazil, we've got one in Spain, we've got one in Hong Kong. We've probably done something wrong somewhere. So it's quite nice to get that kind of bill of health.
That's interesting.
But yeah, there was no low point during the process, really. When Brainlabs did absolutely everything they said, the deal we ended up with was word for word what they put on the LOI. So yeah, I think we were just really lucky.
That's amazing. It's amazing. It sounds like you had some great investors who gave you the benefit of their wisdom and experience. What else did you do to educate yourself about the process of exiting, selling? Are there any resources you can point our listeners to that they might benefit from?
Founderon.com, the best place to find out how it feels to exit your business, of course. I think there's a real lack of information. Like if you search what is an earnout, you're just going to get loads of lawyers saying here's how to structure an earnout. So I think the fact that you're doing this podcast, it's information you just can't get online. So I think my advice to anyone that's thinking about exiting a business is find some kind of advisor that's done it. Don't find someone that knows all there is to know about exiting a business. Find someone that's done it, and they can be like, watch out for that, double down on that, be prepared for that. That'd be my advice.
What did you buy yourself to commemorate the win?
What did we do? So we tried to buy a house straight away, but we kept getting outbid. And I was like, surely this isn't how it's meant to be. I meant to walk in and just like throw some money on the floor and go, we'll take it. But we just kept losing out on the houses we wanted. So I think the first thing that we did that I would never have done before, we always used to go to Twickenham to watch England rugby. And I always wondered what it was like behind the scenes in those hospitality suites. So we just booked 4 tickets, went with a couple of friends and lived the high life. But then, I tried to take my dad to it because we always used to go together. And he was like, no, that's not how it is. We go in the normal seats. And then I finally managed to take him and we went in the good seats. And then the next time we went back to the normal seats. He was like, it's just not the same. So we experienced it, but then we reverted back to standard.
This is watching England in the Six Nations?
Yeah, exactly.
Fantastic. Well, that's fun. I would love to do that with my dad one day as well. So have to put that on my bucket list. The blog is founderon.com. Chris, where else can people reach out to you on social? What are the best places to do that?
The only place is LinkedIn. I think I probably had a Facebook account about 10 years ago, but LinkedIn is where I spend my time. And yeah, it would be great to hear from people that have exited or are thinking about exiting. And any ideas for blog posts, are more than welcome, because I'm a full-time blogger for the foreseeable future.
And rugby fan. I will put all that in the show notes at builttosell.com, your LinkedIn profile, the link to founderon.com. Chris, thanks for doing this.
No, thanks for having me. Great to chat.